it's all about cash. But what really matters from a day-to-day perspective is where you are from a cash position.
Good evening, everyone. Welcome to Entrepreneurship 101. So hello to everyone that's watching from across Ontario as well. I'd like to welcome tonight's speaker, Andrew Graham, who has been supporting the program for a few years, 3 or 4, we're not sure. And Andrew is the co-founder and CEO of Borrowell. It's a Canadian marketplace lending platform serving consumers with good credit scores. He leads a dynamic team dedicated to bringing better rates and service to borrowers as well as attractive returns to investors. And before founding Borrowell, Andrew led the insurance business at PC Financial, which saw record growth and became a leader in online sales during his tenure. Please welcome Andrew, who's joining us again tonight. Thank you.
It's great to be here. Hi, everybody. I'll try to be conscious of the fact that I know there are many people in the audience here, but there are also many people in the audience in other places. And I'm hoping to have a bit of a dialogue with the audience here, and I'll do my best to repeat the learnings or whatever we hear from people in the room for people who are not in the room. I'll tell you a bit about myself, but before we do that, I want to better understand who some of you are and who you are as an audience. So I got a couple of questions, and again, I'll share the results with folks who are not in the room. So first of all, who here is an entrepreneur who's founded a business or plans to found a business soon? Okay, more hands. That's great. Who's working in the private sector in a larger company? Okay, a few people. And who's here from the not-for-profit sector or the social sector? Okay, a bunch of people. That's great. Okay, so that's question one. I would say the split for the folks not in the room, it was sort of a slight plurality of people who are entrepreneurs or starting their own businesses. Not many people from larger companies, and for me, a surprising number of people from the social or non-for-profit sectors. That's great. So the second question is, how well do you feel as an audience that you know, or do you as an individual feel you know financial planning? And if the choice is very well, somewhat well, or not well at all, who knows it? First of all, let's start with very well. Okay, there's about 3 or 4 hands up here. I hope that you get something out of tonight, because we're going to be tackling this at a fairly sort of basic level, which is the level I'm certainly most comfortable with. So I hope it's an interesting night for you. I may be relying on you for some advice. Who knows it? Who would say they know financial planning sort of somewhat well? About maybe 10 hands or so. And then who knows it? Who feels they sort of don't know financial planning at all, or it's not an area of strength? So sort of the rest of the audience. Okay, well that's great. I think you're in the right place, and we're going to do our best. I'm going to do my best to make this talk useful, and it's really designed for the startup CEO who's not an accountant by background, maybe doesn't feel this is an area of strength. So it's sort of, what do you need to know to be able to ask dangerous questions? We're not going to be giving any chartered accountancy designations at the end of tonight. We're really going to sort of focus it for the startup CEO who wants to be able to know enough to be dangerous. So a bit about me. As mentioned, I'm the CEO and founded a company called Borrowell, which makes loans for Canadians with good credit scores. And if I can make a plug, we'll be launching very soon, and you can sign up on our website now, in fact, if you want to get information about our launch. If you're someone with a good credit score looking for a loan and you're employed, come to our site. We'd love to have you try it out. And frankly, I think as a startup CEO, it would have been irresponsible of me not to do that. For all of us in the room who are starting companies, we know that you have to take every opportunity you can to try to sell. You remember this scene, of course, from Glengarry Glen Ross. I think that's got to be certainly our motto as founders. So financial planning, maybe not the sort of the most fascinating or exciting topic for everyone, though I think it very much is. I should have asked, there were a few hands that didn't go up. Is there anyone here on a first date tonight? Okay, so maybe not a typical place to go for a first date would be a financial planning lecture. I think, as usual, Dilbert gets it right on. I'll give you a second to read this. But financial planning, as tough as it can be, is really important for running a successful business. So why does money matter in a startup? Why does it matter that we talk about financial planning? And before I sort of get you to answer that, I was having a conversation with someone the other day, and they said, does this topic of financial planning even matter anymore? Isn't it about fast iterations? Do you really want to get caught up in a business plan that may change tomorrow or next week? Isn't this sort of old thinking, the whole idea of even planning in a startup? So I'm interested, who's got sort of arguments against that? Why does money and planning, financial planning matter in a startup? Any thoughts? Right, so if you want to see growth, it's your bottom line. You've got to focus on it. And I think that's great. That's a great place to start. You have to pay the bills. If you're going to run a business, you have to be able to pay the bills, pay your employees, pay your suppliers. What's another reason? Increase the confidence of your investors that you're onto something. I think that's great. It's the sign of a successful business model. I love how people are answering actually in the order that it's on the slides. That's really helpful. What's another reason, a final reason here? Yeah. Some control so that you know what's going on, your business knows what's going on. That's a great answer. Unfortunately, it's not what I had in my third circle. I'll tell you what's in my third circle, which is that it's a desirable outcome. For those of you in the room that are sort of capitalists and are looking to found businesses that are going to make money, you want to have a business that makes money. And that can happen by accident, but more often than not, it comes with a good and thoughtful planning. So we're going to cover a few different sort of essential tools tonight for someone interested in managing a business. And that's the income statement, a cash flow forecast, and the balance sheet. So for those of you who are accountants, you'll know there are many other tools we could be looking at. There are many sort of layers of depth to each of these. But really what we want to do is have everyone here leave being at least familiar at a high level with what each of these tools is and when you would use it. So let's jump in first to the income statement. So the income statement really is sort of a dashboard for how your business has done over a period of time. Usually it's for a year, a quarter, or a month. I mean, you could do an income statement, I suppose, for a day, but typically it's an income statement is something you'd look at quarterly or annually. And I think the best way to talk about an income statement is to look at an example of one. And I've chosen Amazon.com. It's a company who here has ever, who's never tried Amazon? Let's try it that way. Almost everyone here has tried Amazon. So what does Amazon do at a really simple level? Anyone want to jump in and hazard a guess? Or it sells stuff. And not only it sells stuff, it actually sells and ultimately makes sure it gets to your door. And Amazon, as we know, sells a wide variety of stuff. So we're going to go through the income statement really line by line here. So first of all, we have revenue. And what revenue is the money that's brought into a company by its business activities. And we'll talk later on as we go through the income statement that there can be money brought in through other things that aren't core. So if you run a business selling goods like Amazon does, Amazon also may have cash in the bank and may earn money with the cash it holds. But really its core business is selling stuff. So revenue is the amount of stuff that Amazon sells in a year. And these are actually true numbers for 2014. Amazon sold almost $90 billion worth of stuff. That's a lot of stuff, actually. And we heard in the intro video, there's two different ways to think about revenue forecasting. And revenue forecasting really is a key function for any business. The first we heard is top-down revenue forecasting. Anyone want to sort of give a summarized version of what we heard in the video? What's top-down forecasting? You look into the market first, and then based on the size of the market, you estimate what you're gonna take. Yeah. Yeah, so what are you going to get versus others in the market? I think that's exactly right. That's a great example of top-down forecasting. So you say, the market for my product is $10 billion, and I'm going to have 1% of it. And that, here's the amount I'm going to get. Or I'm going to spend $10 million on marketing, and I think that's going to translate into this share of the market. So top-down forecasting, I think, is very common in startup land. I'm sure all of us who've put together business plans, we've certainly relied on it in certain situations. I know I have. It's certainly a useful starting point for a startup to say how big is the market and what do I think I can get. But it's arguably not as good or not as detailed, at least, as bottom-up forecasting. And can anyone talk about bottom-up forecasting? How does that work? Yeah, so you look at sort of individual sales and you look at individual customers. I think that's sort of one of the key words for bottom-up forecasting is you're making educated guesses about what individual customers are going to buy. So a bottom-up forecast might say, here's the sales funnel. There's 20 customers out there in the market. I've spoken to them or I know them. I think there's a 50% chance that I'm going to get each of them to the next level. Here is the average size of the deal that I think customer A is going to give me versus customer B. And you really you've built from the bottom up, meaning you've taken each customer and you've sort of built from there what your forecast is going to be. So bottom-up forecasting takes a lot more time. It takes a lot more knowledge of the market, but it gives you a richer and ultimately more detailed and I think more defensible way of forecasting revenues. It's going to be more powerful if you're talking to an investor to say, I sell products to airlines, and I've actually spoken to Air Canada, I've spoken to WestJet, I've spoken to American Airlines, and here are the results of the conversations, and here's the degree of certainty I have for each sale. So next on the income statement is cost of sales. So these are the costs that go into creating the products and services that a company sells. So if you're Amazon and you're selling books and stuff, what's your cost of sales? The product costs and delivery costs, I think those are both great. There was another hand over there. Yeah, so distribution costs. So it's if you're Amazon selling a book, you've got to buy that book from someone. So your cost of sales is what you paid the publisher for the book, or what you paid the supplier for the toothbrush or whatever, as well as in Amazon's case, the delivery cost. So if Amazon is charging you a delivery cost, they have to then, and that would be in revenue, in cost of sales would be whatever it costs them to pay the delivery company to deliver it. An easy rule of thumb for is something in cost of sales or not, because Amazon has other costs, right? Like they have a head office, they have warehouses and all that sort of thing. And we'll talk about later how those are not in cost of sales. A quick way to think about is something in cost of sales is to ask yourself, if I were to sell one more unit of something, would I need to pay for this? So if you're going to sell one more book, do I need to buy an extra book to sell? Yes. Do I need to pay shipping costs? Yes. Do I have to hire another CEO? No, I don't need to hire another CEO to sell one more book. So that's a sort of easy rule of thumb for figuring out if something is in cost of sales. Now, when you subtract cost of sales from revenue, you get what's called gross margin. And gross margin is sort of saying at a very high level, before you've covered other costs like head office costs or your CEO's salary, is the business profitable? And I think it's fair to say you've probably got a problem if you don't make gross margin, because it means you're selling stuff for less than you're paying for it. And gross margin's a really good indicator of how a business runs. And there's no right answer to what gross margin should be. It really varies a lot by industry. So Amazon's gross margin we can calculate is 29%. That's just gross margin over revenue. Next we have LinkedIn. So what does LinkedIn sell? Has anyone bought something from LinkedIn? Yeah, over there, yeah. A service? What kind of service do they sell? Yeah, networking. So you can buy a premium package on LinkedIn, or you can buy ads on LinkedIn. So do you think so if that's their revenue, what do you think their costs of goods are? So for LinkedIn to sell one more premium package, do you think there's a lot they have to do or a little? So maybe there's a computer scientist to code it, but if that computer scientist is coding it for everybody, that wouldn't actually be a cost of sale. You really have to, it's sort of like, what do you have to do to sell one more? And in LinkedIn's case, it's like very little. Once you've built the code, you can sell 10 or 100 or 1,000. So from there, we can sort of guess, is LinkedIn's gross margin percentage going to be higher or lower, do you think, than Amazon's? Higher, yeah. And LinkedIn's gross margin percentage is actually 81%. Now let's go to the other end, or a different part of the economy. Toyota. So what does Toyota do? Toyota makes cars. That's exactly right. So do you think Toyota's gross margin is going to be bigger or smaller than Amazon's? Smaller. So why do we think it's going to be smaller? It's really expensive. It takes so much to make one car, right? I mean, a lot of it's expensive to make a car. It's not expensive to make a new premium member in LinkedIn. It's very expensive to make a car. And you're absolutely right. Toyota's gross margin is only 13%. So again, it's not to say that one is better than another. I mean, Toyota has built a great business. Amazon's built a great business. So has LinkedIn. It's just sort of a function of what industry you're in and how your production works. So next we go to operating expenses. And that's sort of everything else, if you will, not related to directly producing the good or service, excuse me. And sort of the most common bucket, or a bucket that's talked about a lot there, is selling, general, and administrative expenses. People say SG&A. And that's a whole bunch of different costs. Anyone want to throw out some examples for Amazon specifically? Buildings, rent, yeah, that's great. Any of the perfect, pardon me? Utility bills, that's great, yeah. Trucks, yeah, sure. What about, or Jeff Bezos, what about his salary? You could throw that in there as well. So there's a lot that goes into SG&A for a company like Amazon. Typically, marketing would also fall into here. So for a company doing a lot of marketing, that can be a big driver of this line. Next is research and development, and I've had to sort of massage the terms a little bit here. Amazon doesn't actually report research and development. They call it technology and content, which is a good reminder that while there are sort of rules and standards around things like income statements, different companies sort of take different takes. And one challenge is trying to sort of equate one with the other. But Amazon calls it technology and content. And there's not a huge amount of clarity about what falls in here for Amazon. But we know as Amazon ramps up its role as sort of a content creator, there's increasing spend there. We also know there's a lot that Amazon spends on technology, of course. Next is depreciation and amortization, which are, I always think, fairly complicated or less clear or less obvious concepts. Depreciation and amortization is sort of how we spread the cost of something that's long-lived over a period of time. So in accounting, if you buy a car that's going to last for 5 years, you wouldn't show the full cost of the car in this year's income statement. You'd actually show it, depending on how you do it, but let's say to be simple, you'd show it 1/5 this year, 1/5 next year, et cetera, for 5 years. So and that's where that sort of item would come in. And if it's something tangible, that's depreciation. Amortization is sort of the equivalent for intangibles. And we won't get into too much depth here. I think we're starting to get into sort of more technical accounting. But the way I think about amortization is it's stuff that you can't touch. So if you buy a business and inherent in buying the business, you're sort of paying for more than assets. Maybe you're paying for the brand. What is a brand? You can't really touch it. So you'd amortize the cost of that over a period of time. And my friends in the audience who are accountants would be able to tell you even more about that concept than I just have, certainly. So moving down the income statement, if you subtract 25,925, which is the total operating expense from the gross margin, then you get income from operations of $311 million, which is the line above what I'm showing on the slides there. And that's your income from operations. So that's sort of like, once you take what's left after buying the stuff that you're going to sell, so in Amazon's case, what's left after paying for the books and the delivery, and then also all your operating expenses, things like warehouses and trucks and head offices and CEOs and all the other things, that's what you're left with. And then for many businesses, there's then other costs. So for example, interest and other income and expenses. Amazon makes money from having cash in the bank. Sometimes it has to borrow money, and that's where things like that would factor in. And then finally, taxes. Sort of amazing when you look at Amazon's income statement. The company did $90 billion in sales and paid $167 million in taxes, which is quite the ratio, and I think speaks to how little income from operations there is left after all of their costs. So anyone who knows Amazon has been following that story. This is a company that's had tremendous growth and is highly valued on the stock market, but then you look at their net income, and they actually lost money last year. So Amazon is a business that is losing money, or at least did in 2014. Okay, well, an income statement, I think, is certainly one of the most important places to start. It's one of the kinds of statements you'll see most often. And I think if the key concepts here are really sort of revenue, cost of sales, operating expenses, and then everything else. And I think you can sort of slot for your own business what might fall into those different buckets. But interestingly, income statements aren't about cash. And I gave you a few examples there. So if you remember the concept of depreciation, if I buy a truck this year that is $10,000 and it lasts 5 years, and we use what I sort of described, which was straight line depreciation, how much of an expense is going to show up on my income statement? So it's $10,000 the last 5 years. $2,000. So $2,000 shows up on the income statement as an expense. But how much have I had to put out the door? How much cash have I lost? $10,000. So that's a great example of the disconnect between cash and an income statement. And that's not a knock against income statements. Income statements have a job to do, but they're not cash. And for many of us who are running companies, especially startup companies, cash is as important or even more important. And we're going to spend a bit of time looking at why that is. So we have this company that I've invented called Tom's Solar Power Company. It's a very simple business model. Tom buys solar cells and then installs them on people's roofs. And he buys the solar cells for $50 and he sells them for $100. So, nice business, good, nice gross margin, good opportunity for Tom to make some real money. And Tom's, like any good startup entrepreneur, has his nice revenue forecast, which is always up and to the right. And let's say Tom has really done his homework, and this is a bottom-up forecast. He's gone out to customers. He's got customers that he's not only spoken to, but let's say he's even sort of lined them up. They've said, yeah, you know what, Tom, I'm absolutely going to buy 5 units from you in February if you get this done. And someone else has said, I'm absolutely going to buy 50 units from you in June if you can supply at this quality. So Tom has built his revenue forecast. And let's say, for our example, that for the first time in the history of the world, his revenue forecast actually comes true in every month to the penny. Okay, so this not only is a forecast, but let's say that it's actually going to happen. So you can see month by month what's going to happen. And in each month, there's a projection of units sold, and that's the top line that I have there. There's a unit price, which you've already said is $100 a unit. And then you can see the resulting revenues. And that should be, if all the math is working properly, it's simply units sold times 100. So he sells 50 units in February, and that gives him a revenue of $5,000. Okay, so there's nothing, I hope nothing complicated going on here. This is a business that's showing great growth. Tom feels very confident about his revenue assumptions, and we've said they're actually going to work out. So, what's not to like? This seems great. So let's look at how this appears from a income statement perspective. And we've made one other assumption here, that there's SG&A, which is, as we mentioned, a line that pretty much any business would have. And that's Tom paying himself a salary of $1,000 a month. So you can see that really it's a fairly simple income statement. You've got revenue minus cost of sales, which gives gross margin, and then minus SG&A gives you net income. And if we can go back and forth, you can see that there's no sales in January. There are 50 sales in February. So in February, you have revenue of $5,000, cost of sales of $2,500, and gross margin of $2,500. Okay? So very hopefully relatively straightforward company and plan so far. So let's see what happens though from a cash perspective, because I want to introduce sort of a bit more complexity to this that I think actually makes it realistic. So let's say that you're Tom and you're running a solar power business, and you've got to go out and buy these solar cells, and you find a supplier that manufactures them. Okay, so you're Tom. Your business doesn't exist yet. You've just raised some capital from investors. What do you think the supplier is going to say when you say, "I want to buy from you"? Do you think they're going to make you pay, months later? When you place the order, when you get the solar cells? Anyone dealt with suppliers as a startup? Yeah. They're going to want a deposit maybe, or they're going to want some other structure where they're going to get certainty that if you place an order, they get their stuff. So in this case, Tom's supplier says, you know what, every time you place an order, I'm going to take full payment, and then I'll deliver a month later. Okay, so if you place an order today, I'll take payment from you today, and then I'll deliver in 30 days. This is not an unrealistic assumption for many kinds of suppliers. And then on the other side, when Tom is selling, he's selling his solar panels to individuals or to companies, do you think Tom has the power to make them pay right away? Has anyone run a business and sort of run an accounts payable process? What are typical, or what are some examples from your life of typical payment periods? Yeah, in here? So net 30, so 30 days, people have to pay in 30 days. Anyone else? So net 30 is very common. I was talking to an accountant friend today. He was saying that amongst the big telcos, he gave one example of 45 days. So they'll pay their suppliers in 45 days. And then I come from the world of large retail. I was at PC Financial, which is owned by Loblaws. And without singling any retailer out, it's often 60 to 90 days. So if you're selling Walmart bananas, you deliver the bananas, you may not get paid for 3 months. Okay, so this is the world we live in, and it's hard if you're Tom to push against customers who say, well, that's fine, I'm happy to buy, but I'm going to pay you in my payment terms, which are 60 or 90 days. So in our example, we've said Tom finds customers that are relatively kind. They'll say, we'll pay you in 30 days. So Tom, once you install, I'll pay you 30 days later. So let's see what happens when we play these out. So Tom has raised $25,000 of starting capital, which seems great, right? Because he's got a product that makes money. He's got a great sales forecast, a great gross margin. So why would you need a lot of money if you're running what looks like a great business? So let's see what happens in January. So Tom is selling, as we said, 50 units in February. So he's got to put the order in January so that he has the units in February to install. So he has no revenue in January. And if I can make the laser work here, let's see. So he has no revenue in January. But he does have costs because he's got to buy the units at $50 each for February. He's got his SG&A. So his actual cash loss in January is $3,500. Okay, so this is the startup month. We always lose money at the beginning. Maybe no reason to be concerned. So let's see what happens in February. So in February, big month for Tom. He actually makes his first installations. He earns his first revenue. He's installed 50 units. But for some reason, there's no revenue. Excuse me, there is revenue, but there's no cash because the cash is a month delayed. He's not going to collect that until the next month. But he has to order the panels for the next month. And you recall that the sales are increasing threefold. So he's now going to put $7,500 out the door in February to pay for the panels that he's going to install next month. So now we go, even though he's now made his first sale, he's made his first revenue, from a cash perspective, he's lost $8,500. And he's now down to $13,000. So I'm sure you can kind of guess the next few months in this story. Similar thing, March is a great month for sales. He actually gets his first cash in the door from the customers in February. They all pay him. He makes his $5,000. But still, he's making a net loss from a cash perspective, or there's a net outflow of cash. And now, look what happens to him in April. We've got this thriving business with a great product that customers want. He's got customers lined up. He's selling it at a great gross margin. And he goes out of business. He goes bankrupt in April because he's got to pay for solar panels today, and he's not collecting the money on those solar panels for 60 days. So the harsh reality in the world of companies, especially new companies, is you can have a great business plan, a great product, great customers all lined up, a great gross margin, and still go out of business if you don't manage your cash and manage your growth. Okay? It's kind of when I first sort of came across, I thought, that's crazy. He's running a great business, he's a great entrepreneur, and look, he's gone bankrupt. And of course, the story improves as cash sort of starts to catch up, but that's many months away. And certainly, one of the key lessons for Tom is you should have raised more money, Tom. You should have done the projections. You should have seen what your cash needs are going to be. And you should have raised enough money up front to be able to cover your losses, your cash flow losses in the first few months. So the lesson here is it's really important to forecast cash flows, because if you don't, it's sort of like flying blind. And I love this photo because it doesn't look like a great position for a plane to be in, but it's sort of like, but this plane is sort of like an income statement in that you don't know, unless you look at cash, where it's going. Okay, so it's actually a much worse situation than might have first appeared. A concept I'm going to talk about only very briefly, and that's EBITDA. And EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And I think it's a concept that we're not going to talk about a lot today, but I think it's important that we all hear it and have a very high-level understanding of what it is. And really, it's a way to measure cash flow from operations. So it's trying to take into account, in some ways, for the deficiencies that we saw from the income statement earlier. So people in investing, people in private equity, often say, well, I don't want to see the income statement. The income statement doesn't show me really what's happening in the business. I want to see EBITDA. Now let's talk about the balance sheet. So whereas the income statement was a look at a company over a period of time, like a quarter or a year, a balance sheet is a snapshot of the company's assets and liabilities at a point in time. So we're back to Tom, and this is his balance sheet for the end of February. And you'll see here, Tom, we showed the cash that Tom has. We can see the accounts receivable, and accounts receivable are what his customers owe him. So that's viewed as an asset because it's something that he's going to get or that he legally will get. We see his inventory, and that's those solar panels that he has to be installed. And then we see other things that we didn't talk about before in our example. He's got building and equipment and land. And we're going to talk relatively quickly about the balance sheet. A great trick for looking at a balance sheet is when if you're trying to assess a company, if you're looking at Tom's company and saying, should I invest or not, or should I buy it out? What do you feel more comfortable about in terms of if you're trying to assess the true value of it? Do you feel more comfortable about land or about cash? Cash, because if you're trying to value things in cash terms, cash is cash. Land, maybe Tom bought that 10 years ago. Maybe it's worth $10,000 today. Maybe it's worth $1 million today. You just don't know. And a good trick when you're looking at a balance sheet is the closer things are at the top, if they're ordered in the way that is typical for a balance sheet, the more confidence you should feel. So cash is cash. Accounts receivable, that's things owed from customers. And not all customers will pay. It's not as good as cash. But nevertheless, those are typically fairly recent transactions. There's customers there. They took a product. You can feel fairly good about it. Inventory. Let's say Tom went bankrupt and you bought the business. He's put his inventory there at $7,500. Who knows what you're really going to be able to do with that inventory? Can you resell it? Can you get $7,500? Who knows? Building, $50,000, like land, maybe that was purchased a long time ago. Who knows what it's worth today? Maybe Tom built a really fancy building and it's actually not worth $50,000 from a recovery perspective. So typically, if a balance sheet is ordered correctly, you should feel most confident about the things near the top and feel more concerned about the true value of things near the bottom. So there's assets in a balance sheet, and then of course there's liabilities and owner's equity. So you can sort of think of it as what does the business have, what does the business owe, and then what's left, whether positive or negative, is what the sort of residual value is for the owners. So this is so we have the income statement and we have the sort of the cash projection. We've talked about income statements before. This is an income statement for a month, and you can see how cash and the income statement differ fairly significantly. The cash projection is starting with a cash amount and subtracting what happens to give you an ending cash. And you can kind of see how the different statements sort of work together. So you've got ending cash at the end of February here, and look, that actually matches perfectly with the cash on the balance sheet. Another way the statements sort of talk together is there's revenue for the month, and that's actually turned perfectly into accounts receivable. So when you have financials that are properly done, there's sort of good symmetry or good ways that they interconnect. So sort of a few last thoughts before we wrap up, and I'd like to sort of summarize what we've talked about and then leave time for some questions or for some discussion. So first of all, it's all about cash. So I think can't say it enough. Cash really is what matters in a business, especially an early stage business like the kind that many of us are running. If you've got a great income statement, that's not. That may help you with investors, but what really matters from a day-to-day perspective is where you are from a cash position. Because if you don't have cash in the bank, you can't use an income statement to pay your suppliers. You can't use an income statement to pay your employees. Really, what it comes down to is cash. Next is, to the extent it's possible, forecast from the bottom up. So especially if you're selling to businesses, there's nothing better than going out and talking to customers and being able to say to investors, look, I've got signed letters of interest, or I've had these conversations, or I've even got sort of conditional contracts from these 5 different customers. Like, wow, that makes your business feel totally real. It's much easier, and I think more sort of worry-inducing if your only argument is to say, well, the market's huge, and wouldn't it be easy to get 1% of it? I mean, I think as all of us know, all of us who are in business and have tried startups know, getting 1% of any market is actually really hard. It's not easy to get 1% of the market for consumer lending. I talk a lot about there's $75 billion of credit card debt out there. We'd have a great business if we could get 0.1% of that, but we know that we're going to have to fight tooth and nail for every single customer to get even close to that, and certainly in the near future. So bottom-up forecasting should give you the most confidence, and I think ultimately is key for your investors. And even if you do a combination, so maybe you say, listen, I think I can get 20 customers in the first year, and to give you some proof, Mr. Investor or Mrs. Investor, look, I've talked to these 5 people, and they've all agreed to sign up. They're all really excited, and there's another 15 in the pipeline that I think if I talk to, I can get. The more you can put sort of flesh on the bones of who your customers are and where your revenue is going to come from, the better things are. Next is sort of, we've looked at fairly static income statements and fairly static cash flow projections. One thing that's great to be able to do with these, if you're at all sort of competent in Excel or someone is someone else in your team is to be able to run scenarios. So in Tom's business, when he was going out there, he could have run scenarios like, well, what if there's a 10% increase in my cost of goods sold? What if the price of silicon goes up? And if you have it all in Excel, you can plug it in and you can say, wow, what does that do to my net income? Or similarly, you say, what if the price of solar panels goes down and I'm stuck with a bunch of inventory? What is that going to do to my income? So the more and I think more than anything, it really gives you a sense of what drives your business. So in Amazon's case, for example, an increase in the cost of CEO compensation isn't going to make nearly as big a deal for them as a big increase in the cost of books or shipping or something. Those kinds of things are going to matter more. And the more you as a CEO can say, what really matters for our business are the cost of these 3 things, or the price, or whatever, or this kind of variation in price, that's really key. And I think it also allows you to do creative things. So if you're an airline, we talked about airlines earlier, one of your key drivers is the price of jet fuel, right? It's the price of gasoline, which is driven by the price of oil. So maybe what you want to do as someone running an airline is to say, I know that's one of the big drivers of my business. Listen, if the price of peanuts goes up or down, it's not a big deal, but boy, if the price of gas goes up and down, that's a big deal for me. You can then plan and have strategies to sort of deal with that. So really understanding what drives your business is really key. And the last thing I'll sort of say is get expert advice when you need it. As I started off by sort of being clear, I hope that I'm not a professional accountant, and I think that's hopefully why I can at least try to be a bit useful and say, if you're a non-expert, this is how I think you should approach things, this is how I approach things. But ultimately, there are people who do this for a living and who can tell you in great detail whether something goes into would be an expense, a cost of goods sold, or would go into SG&A, and that stuff matters. So I'll tell you, in our business, it was really important for our investors, even though we only raised money last year, that we got our financial statements audited for 2014. So we're an early stage business, but they said we want confidence that these have been looked at by professionals who understand accounting rules, so that we know that what you're showing us is correct. So there's no substitute for professionals. So I think it's important to know when you can sort of know enough to be dangerous in the planning you're doing, but then when you ultimately need to go ask a professional for help. And to be clear, nothing I said today should be constituted as professional advice or help. So with that, I'll wrap up, and I'm happy to take questions as best I can. If your question's a technical accounting question, I'm probably not going to be able to answer it, but happy to talk about sort of accounting issues and business planning and financial forecasting for startups.
Hi, thanks for the talk. My question is, can you add things like IP or know-how to assets? And if you can, how would you determine the value of things like that?
So can you add IP or know-how to assets? So it's a great point, because it's kind of a deficiency if you think of financial statements. A lot of what you've built in your business are these sort of intangible assets like IP, like how you do things, your intellectual property. But in let's call it in sort of the base case of accounting, it's actually very hard, or it's not typical to add those things, especially if you're sort of a company that's never been acquired or anything else, because it's hard to value them. And I think that's how an accountant would answer that question, would be to sort of say, because you can't put a value on it, so if you buy a piece of land, there's a value, you paid a certain amount of money for it, but if you've come up with a patent, it's very hard to value that. So the general answer is no, you wouldn't. If you were to go out and buy a business and you were paying more than the rest of the assets in the balance sheet, in that case you might treat intellectual property and other things like a brand as assets in the balance sheet, but typically when you're building your own business you wouldn't. Which seems really unfair because I know that's where a lot of the value of your business is, but accounting's there to be sort of precise, not necessarily fair.
So in the case of something like Tom's Solar, what type of strategy could he have developed to help attenuate the fact that his business was eventually going to sort of go bust?
So what do you think? What would you advise Tom to do next time?
Well, first of all, get more investors. That's an obvious one. But let's say the market shifts and suddenly the value of solar or the cost of silicon goes up. He has to start paying more. How can he accommodate that when that's a very short-term change that has very heavy impacts on his immediate growth strategy?
Yeah, I mean, so stuff's going to happen in whatever business you're part of, and you can't always prevent it or always mitigate it. But I think what the key takeaway for me is from the Tom example is that you've got to be planning for it. So you've got what I think Tom should have done is he should have sat down and said, let's say my business works out exactly as I plan for it to work out. What am I going to need from a cash perspective? That's sort of step one. So if things go exactly as I plan, what's going to happen? And then step two is to say, well, what if things don't go exactly as I plan? What if they get sort of worse in this way or that way that are likely or possible? Then what am I going to need from a cash perspective? And then approach the investment round or whatever it is that way. So, and that's not going to mean that Tom will survive any problem that's out there, but it does mean that he'll at least have a well-developed plan for if things go as he hopes, and then at least some understanding of or some buffer for if things don't go as he hopes.
My question is for Tom, does he pay himself salary? Does he count it as a cost?
Yeah, so in our example, we had Tom paying, I think we said he's paying himself $1,000 a month as salary. That's what we counted as SG&A, really in a very simplified way. So maybe one thing Tom could have done was stop paying himself salary, and then he would have saved $1,000 in cash every month.
Thank you for the presentation. A gross margin basically determines the viability of one company?
Gross margin determines the value of?
The viability of a company over time. Does it determine that?
So I would say the viability of a company over time is driven much more by either net income, some combination of net income and the cash that's being produced. So EBITDA would be a measure of that. Because I think as we saw, like Toyota has a much lower gross margin than LinkedIn. But which company is more viable? I think you could make arguments either way. I think you could say, listen, Toyota's been around a lot longer than LinkedIn. It's much more viable. I mean, someone else could argue LinkedIn. So I would say gross margin tells you about the industry. It may tell you about the company, especially if you compare it to its peers. But I don't think it tells you about fundamental viability.
Hi, I just wanted to add and respond to that last question. And this is from real world experience. What Tom should do is say to his supplier, listen, I'll pay you up front 100% this month for the product you're going to supply to me next month. And next month, I'll pay you 75% and work it out till he's got terms. And on the flip side, with the customer, is offer them a discount at the beginning. You're starting off. Everything's negotiable, right? Nothing's set in stone. But what I wanted to add to your talk is that this is an ongoing process. You don't do it once. You have to keep doing this. You have to keep looking at your numbers. You have to know where you are at all times.
I think those are both great comments and good suggestions for Tom.
I have a question from online. Is it still okay to meet with potential funders like banks and angels when the books are red?
When the books are in the red, meaning sort of a loss? Yeah, I mean, I think what's most important is that there's a plan. I mean, if startups never met with funders when they were losing money, there would be very few meetings with startups and funders. I mean, look, Amazon is still in the red, and yet it's doing well and can access the public capital markets. So I think what's most important is showing that you have a plan. Is to sort of say, look, we're not going to be profitable this year, and we're not even going to be profitable next year, but we've got this plan to be profitable in 2 years once we get to this market size, and here's why we think we can do it, or once we introduce the premium feature on our app, what have you. So I think it's much more about telling a story, a true story, or a story that fits with what you want to do, than it is about where you happen to be today. That's my experience from having gone through a fundraising round just last fall that we were very happy with the outcome of.
How do you tackle investors that are always looking for growth, regardless if the profits are not growing, or in the case of Amazon, they don't seem to ever want to make any money? And in smaller startups where you're looking at very small growth, but there's always profit, the corporate investors always want, tremendous growth against profit. So how do you justify it, and how do you take advantage of that?
So I think a lot of it, I don't know, was anyone here this morning for Dan DeBoe's talk? Dan talked about marketing and being able to sell a vision and sell a story. And I think for investors, that's really the key thing as well. It's being able to sell a vision and sell a story for what your company is and where it's going to go. And so you can imagine that where you are financially is important, but there are many corner stores in Toronto that have more net income in 2014 than Amazon. But if you were out there in the market buying companies, would you pay more for a corner store or for Amazon? You pay more for Amazon. You say, wow, Amazon has an amazing story to tell. They've got millions and millions of customers. They're growing at rapid rates. They're the leader in many markets they're in. And they're more concerned about getting market share and getting penetration and getting new products to market than they are about short-term profits. And I think that's been Jeff Bezos' line from the beginning, sort of say, if you want short-term profits, you're not the right investor in Amazon. So he's able to tell, I think, a great story, and a story that many people find convincing because he's been able to sort of do this, not make much money for a long time. And I think with investors, it's really about being able to tell a story that makes sense. And from my own experience, I mentioned that we raised some money last year. That's really what it was about. It was about saying, listen, we think there's a big opportunity in Canada and beyond Canada, indeed, to sort of change the way that money is lent and money is invested. There's all these people out there that are paying huge rates on credit cards. And we think we can serve them better using technology. And we think at the same time that we're serving them better, we can actually make good returns for our investors who are funding those loans. And look, we've got a great team. We've got this person who was head of risk at this company. And so we were able to sort of package that together as a story that I think was compelling, certainly for the people that invested in the company. So I think being able to tell a story that's supported by your numbers is really key. That's much more important than the numbers on their own. You're never going to go to a meeting and say, here are the numbers. You're going to say, let me tell you a story about the business I'm going to build. And then you sort of say, exhibit A is, here are my numbers. So there's my free advice for whatever it's worth.
Thank you, Andrew, for a very clear lecture tonight and for volunteering your time to join us.